Welcome from me, Guy Monson, to our regular 6-minute strategy. Wednesday's UK budget represented a fundamental shift towards a big state model. In the words of Richard Hughes, chair of the Office of Budget Responsibility, it amounts to one of the largest increases in spending, tax and borrowing of any fiscal event in history. Budget spending policies will add a colossal 2.2% a year of GDP, or 69.5 billion to the economy, 45 billion on current spending and 24 billion on capital items. This will be funded in part by 40 billion of extra taxes per year, the most since Chancellor Norman Lamont's 1993 budget, after Britain was unceremoniously ejected from the European exchange rate mechanism. The irony of this is that the UK economy was performing relatively well in the months before the budget. Growth was accelerating, while the bank's success in fighting inflation was clear. So why did Chancellor Reeves adopt a budget on this scale, and one that will lift government taxes to 36.4 as a proportion of GDP, a full 5.1% higher than pre-pandemic? In short, this budget marks the end of the era of smaller government and takes us to a more classic European tax and spend profile. We'll look at these questions alongside the outlook for sterling and gilts in the slides ahead. So let's begin by looking at the sheer scale of this budget in the first chart here from the OBR. The blue line there, the increase in current spending measures of around 40 billion. The grey line, the increase in capital spending of around about 20 billion. In total, 2.2% of GDP or so increase in spending. That's a colossal number. The yellow bars below showing where some of this funding is coming from, obviously big increases in taxes on corporates and individuals. In addition, of course, the balance made up by borrowing. What's relatively interesting is why Reeves felt she needed something on this scale, when actually the growth numbers for the economy are looking quite good. The Labour Party have inherited actually quite a strong improving economy. UK real wages in the left-hand panel are climbing nicely, increasing spending power. The housing market looks much more robust. The UK composite PMI, that's business service, above that critical 50 number. And UK consumer confidence, yes, it's come off a little bit in the run-up to the budget, but still a much stronger number than 18 months ago. In addition, a very big budget on this scale, of course, has implications for inflation. Now, yes, the inflation numbers are good. The headline rate in the UK, 1.7%. The core rate 3.2%. But as you can see in the right-hand panel, the problem we have is service sector inflation at 4.9%. Now, this is not going to be helped by big demands on the public sector spending from this budget. And in addition, the rise in employer national insurance and, of course, the minimum wage all contribute to making that services sector inflation that much more sticky. So what does the budget look like in the longer-term context? Well, first of all, we're moving to record highs in terms of taxes as a share of GDP. As you can see, those look like they will drift up towards somewhere around 38-39% of GDP, which would be way higher than anything we've seen since World War II, and much closer to the sort of tax and spend ratios that you see in France or Germany. In fact, Germany at 40% of tax as a percentage of GDP will be much closer to where we are. So again, Reeves adopting this European tax and spend model. The increases in borrowing that fund all of this, in addition to the taxes, are funded, of course, by a change in the interpretation of the fiscal rules. We were using public sector net debt, that's the red line there on the right-hand panel. We're moving now to public sector net financial liabilities. This is Reeves's new measure, which includes assets that are productive in the economy and nets that off against debt, which gives her, of course, a lot more headroom. She was wise, in addition to other leaks to the budget. There appears to be a leak to the IMF, and they certainly have backed her approach, at least for the moment, saying there on the left, UK investment and public spending, as well as sustainable tax rises, are to be welcomed. But I think the gilt market will look closely at this and just wonder whether that notably higher public sector net borrowing in the left-hand panel is really sustainable going forwards. All this is in the context of an economy which needs in the longer term to pay down debt. As we approach somewhere close to 100% of debt to GDP ratios, we're not at the levels, as you can see on this chart, we were in World War II, but we have been climbing sharply, especially post-pandemic. To get those numbers down, as we learned after World War II, needs two requirements. One, it needs rather high inflation to burn away that underlying debt. And secondly, it needs high growth so that actually the debt to GDP ratio starts to fall. Now, both of those are difficult today. The question of growth is a particularly topical one, because of course for Reeves this is a strong growth budget, that's her mantra really, but the Office of Budget Responsibility seems to be disagreeing. Compared to our March forecast, yes, growth is forecast to be an average of 0.25 percentage point higher this year and next, but growth going forwards is weaker as these temporary effects fade. So whether this produces a sustainable increase in growth in the UK economy is the real question. So just let's wrap up and look what this means for gilt markets, for interest rates. In the left-hand panel I've shown UK gilts in blue. They've risen modestly since the budget, but were climbing in the run-up to it and are now at 4.35%. Now the move over the budget is nothing like we saw in the Liz Truss budget along that dotted blue line there. But interestingly, actually the yield on gilts is very close to the peak level that those yields reached under her chancellorship. So there's real pressure there in the long term on gilt funding. And you can see that red bar there, that's the German 10-year Bund. That gap between us and the Germans beginning to widen. So the bond market vigilantes are not out in earnest, but I think they're warning the government that there are pressures and issues in that gilt funding market. On the right-hand side, we just looked at the forward futures curves for UK interest rates. Still another one, possibly two cuts for the UK this quarter. I think one is more likely. And interestingly, we're coming now down to a rate for the end 2025 of around 3.9 to 4%. That's about 25 basis points higher than it was on the day before the budget. So one, possibly two interest rate cuts foregone because of a Bank of England that is slightly more nervous about inflation in the aftermath of this budget. Well, I hope that's helpful. I hope it gives you an idea of the landscape and the sheer scale of what has happened. In the weeks and months ahead, as the analysis flows through, we'll be keeping you posted on what this means for asset prices and for your portfolio.